Your raise next year is not being calculated from what you spend. It is being calculated from what a working person spends. Somebody with a commute, somebody with a mortgage and children still at home. The government does have an index that measures what people your age actually buy. It has had one for more than 40 years. It does not use it for this. And the number built on the wrong index is being finished this month. Not proposed, not debated, finished. September is the last piece of it. Here is how that works, and I want you to sit with the arithmetic for a second, because almost nobody knows this part. Your cost of living adjustment for next year is calculated from 3 months of price data: July, August, and September. Only those 3. July is in, August is in, September is being measured while you watch this. When the last of it is collected, the number exists, and every senior in this country finds out in the middle of October what their income will be for the following 12 months. The other 9 months of the year do not count, not one of them. Now, before anybody panics, I'm going to be straight with you the way I always am, because there are 2 versions of this story going around, and both of them are wrong. The first version says the government is deliberately cheating seniors out of their raise. That is not what is happening, and I'm going to explain what is actually happening instead. The second version says the whole thing is automatic, it is nothing to think about, and it lands in January, whatever it is. That one is also wrong, and it is the version that costs people money, because there are decisions you can only make between now and December, and after that, the year is fixed. Here is the accurate version, and it is 3 things. 1. How the number is actually built, and the 2 design choices inside it that decide whether it keeps up with your life. 2. Why a raise can arrive and your deposit can still come out smaller, and the 5 groups of people who have no protection against that at all. If you are in one of those 5, nobody has ever written to tell you. 3. The tax that this raise can trigger, on a threshold that was set in the 1980s and has never been touched since, which means every single raise pushes more people across it. Not because anybody voted to tax them, because a line stopped moving while everything else kept going. And I'm going to close with one figure that puts everything else in this video in context. It is not a number about your check. It is a number about a line that has not moved in 42 years. And once you hear it, the whole design makes a different kind of sense. My name is Kevin. I read the rules so you do not have to. Every week I go looking for the thing that quietly decides what happens to your money, and I bring it here before it costs you anything. If that sounds useful, subscribe and turn on the bell, because September is the month this gets decided, and 2 of the things you can still do about it close in December. Let me start with how the number is actually made, because when you can see the machinery, the rest of this stops being mysterious. Every month, the government statisticians go out and price things: groceries, rent, petrol, doctor visits, thousands of items in cities all over the country. They put those prices together into an index, and the index goes up or down depending on what happened to prices that month. For your raise, they take the average of that index across July, August, and September of this year, and they compare it against the average across July, August, and September of last year. The percentage difference between those 2 averages is your raise. That is the entire calculation, which means something worth understanding clearly. If prices jump in November, your check does not move. If prices jump in February, your check does not move. Those months are invisible to this calculation. They are simply not in it. So there is a stretch of time built into this where you absorb rising prices with no adjustment at all. And you keep absorbing it until the following 3rd quarter comes around, and only if prices are still elevated when it does. Then add the delay on the other end. The 3 months being measured right now do not affect your deposit until January. So by the time you are compensated for what things cost this summer, you are living in a year where things cost something else again. That is not a conspiracy. It is how you build an index that has to cover 75 million people without chaos. But it does mean the raise is always arriving behind the thing it was meant to catch. And if you have ever felt like the increase never quite closes the gap, the calendar is a large part of why. Now the announcement itself. September closes the books on the calculation, and the official figure comes on the 14th of October, which is a Wednesday. It is not a negotiation. It is arithmetic that has already been completed, read out. And the current forecasts, which are estimates only, sit around 3.5% to just under 4%. The Senior Citizens League has it near 3.6%. Another independent analyst has it closer to 3.4%. Earlier in the year, some estimates ran higher. So put a real number on it. On a benefit of $2,000 a month, 3.6% is about $72. On $1,500 a month, about $54. That is the gross figure. It is not what lands in your account. And the reason it is not is the entire second half of this video. One more thing about that October announcement, because people think it is one number, and it is not. On the same day, several other figures for the following year are published together. The maximum amount of earnings subject to Social Security tax. The limits on what you can earn while drawing a benefit before your full retirement age. The amount of earnings it takes to buy a credit toward qualifying. All of it arrives at once, in one release, and the headlines only ever carry the percentage. So if you are still working, or your spouse is, that release contains a number that matters to you far more than the percentage does. And it goes past almost everybody, because the news reports one line out of a page. Let me tell you about Cordell. Cordell is 76 and worked for a paving company for most of his life. He follows this closely. Every October he watches for the announcement, and he writes the percentage in the same notebook he has used since his wife died. Last October he wrote down 2.8%. He did the multiplication and worked out what his new monthly figure should be, and he planned around it. He decided he could afford to have the gutters done. In January, the deposit arrived, and it was not the number in his notebook. It was lower. And it was lower for a reason that has nothing to do with anybody making an error, and everything to do with a second calculation happening in a different building on a different timetable that nobody had ever explained to him. He has been getting Social Security for 11 years, 11 Octobers, 11 notebook entries, and in 11 years, nobody has ever told him why the number they announce is not the number that arrives. That is exactly the gap the Quiet Rules was built to close. Plain English, printed large enough to read without hunting for your glasses, on the handful of things that quietly decide what happens to your money. How the raise is actually calculated, what comes out of it before it reaches you, and what you can still change between now and December. So that the figure you write in your notebook is the figure that turns up in your account. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on a television right now, there is a code on the screen you can point your phone camera at. 7-day guarantee, always. If it does not hand you something you did not have before, you send it back. Now let me go back to the thing I opened this video with, because it is the deepest design choice in the whole system, and it is the one nobody discusses. The index used for your raise is called the Consumer Price Index for Urban Wage Earners and Clerical Workers. Say the whole name out loud once, and the problem announces itself. Wage earners, clerical workers. That index is built around the spending of households where somebody is working for wages. What does a working household spend money on? Getting to work. A car and the fuel for it. A mortgage rather than a paid-off house. Clothes for a job. Children. Now think about your own month, and how little of it looks like that. The largest and fastest growing thing in most retired households is medical care, premiums, prescriptions, the specialist, the dentist, which nothing covers. After that, housing costs that do not fall just because the mortgage is gone, property tax, insurance, the roof, heating a house you are now inside all day rather than out of it for 9 hours. Medical care and housing carry less weight inside the working person's index because working households genuinely do spend a smaller share on them. So when medical costs run ahead of everything else, that shows up in your life at full strength and in the index at a discount. And medical costs do run ahead. That is not a feeling. It is one of the most consistent patterns in the whole economy. Over most stretches of the last few decades, the cost of medical care has climbed faster than the general price level, and the cost of prescription drugs has climbed faster still in many years. Now put that next to how a retired household actually spends. For a working family, medical care is a payroll deduction they barely look at, and a copay a few times a year. For a household in its 70s, it is often the second largest line after housing, and in a bad year, it is the largest. So the thing rising fastest in your life is the thing counted lightest in your raise. And the further into retirement a person gets, the wider that gap tends to open, because medical spending generally rises with age, while the index weighting does not move at all. That is the whole argument in one sentence, and it is why this is not a small technical quibble about statistics. It is a compounding difference between the life the index describes and the life you are actually living. Now here's the part that makes this worth a section rather than a complaint. The government already builds a second index. It is called the Consumer Price Index for the Elderly, and it is designed around the spending patterns of Americans aged 62 and over. Medical care carries more weight in it. Housing carries more weight in it. It exists. It is published. It has existed since the 1980s. It is not used to set your raise. The law names the other one, and only Congress can change which index the law names. And over most of the years since it was created, the elderly index has run higher than the wage earner index. Not enormously higher in any one year, a fraction of a percentage point. But a fraction of a percentage point compounded across a 25-year retirement is not a small thing at all. It is the difference between a benefit that roughly holds its ground and one that quietly loses it. Now let me give you the honest case on the other side, because I do not think you are well served by only hearing one. The elderly index is officially experimental. It is built from a smaller sample of households, and a smaller sample means more statistical noise. Using it properly would cost money to do the survey work correctly, and there is a fair argument that you should not attach 75 million people's income to a measurement that was never funded to carry that weight. And there is a straightforward second argument. Using a higher index means paying out more from a program whose trust fund is already on a timetable everybody can see. Every dollar of a larger raise has to come from somewhere, and the people making that decision are looking at that timetable. So this is not villains against victims. It is a genuine trade-off that has been settled the same way for decades, quietly, without most of the people affected ever being told there was a choice being made. And there is a third index in this conversation that you should know exists because it comes up in Washington regularly and it moves in the opposite direction. It is called the chained index. The idea behind it is substitution. If the price of beef rises, people buy chicken instead. So the argument goes that measuring the price of beef alone overstates what it actually costs a household to get through the week. A chained index accounts for that swapping. As a piece of economics that is defensible, as a rule applied to your raise, it produces a smaller number, year after year, because it assumes you adjust. And this is where I want to be careful and also honest. Substitution assumes there is something to substitute to. You can move from beef to chicken. You cannot move from your heart medication to a cheaper heart medication because the price went up. You cannot substitute a different specialist. You cannot buy less of the property tax. That is the objection people make to it. And it is not a partisan objection. It is a practical one about whether the assumption behind the arithmetic describes an 80-year-old's month. Proposals to switch to that index have been raised more than once, from more than one direction, usually as part of a larger package aimed at the funding shortfall everyone can see coming. None has passed. It remains live, and it will come around again, and now you know what it means when you hear the phrase, rather than having to take somebody's word for what it does. So there are three indexes in play. The one measuring working households, which is the one your raise uses. The one measuring older households, which exists and is not used and would generally have paid more. And the one accounting for substitution, which is not used and would generally pay less. Nobody at that agency chose among them. Congress named one in the law, decades ago, and it has been that one ever since. If nothing else in this video sticks, let that be the thing you carry. Not anger, just the knowledge that the number is a design, and designs have authors, and the authors are reachable by anybody who knows the design exists. And if you want the plain version of all of this on paper, the guide is at kevinexplains.shop, or the code on your screen. Now, the second thing, and this is the one that will affect the most people watching this in January. A raise can arrive and your deposit can still get smaller. Here is why. Most people have their Medicare Part B premium taken directly out of their Social Security payment before it reaches them. You never see it leave. You see the remainder. So there are two numbers moving every year, not one. The raise, decided in October by one agency, and the premium, decided in November by a completely different agency on its own timetable using its own data about medical spending. This year, the standard Part B premium is $202.90. The trustees have projected next year at around $209.50, and some independent forecasters put it higher, in the range of $216 to $219. Nothing is confirmed until the autumn. If the premium rises by less than your raise, your deposit goes up by the difference. If it rises by more, the arithmetic goes the other way. Now there is a protection, and I want to describe it accurately because it is real, and it is also narrower than its reputation. It is called the hold harmless provision. What it does is straightforward. If the increase in the standard Part B premium is larger than the dollar amount of your raise, the premium increase gets capped so that your net payment cannot fall below what it was the year before. Your check does not shrink. Before I go through who it leaves out, I want you to notice something about the timing, because it explains why this catches people every single year. The raise is announced in October. The premium is announced in November. 2 agencies, 2 releases, 4 to 6 weeks apart, and the news cycle has completely moved on by the time the second one lands. So every October, seniors across this country hear a percentage, do the multiplication, and form a picture of next year. And every November, the number that actually determines their deposit is published to almost no coverage at all. By December, the notice arrives with the real figure in it, and by then the expectation has been sitting in somebody's head for 2 months. That gap between the 2 announcements is where most of the disappointment in this subject gets manufactured. Not by anybody misleading anybody, by a schedule. So mark the November release as the one that matters. When the standard premium for next year is published, that is the moment you can actually work out your own arithmetic, and not one day before. And there is a second thing published at the same time, which is the set of income brackets for the surcharge I mentioned. Those brackets shift a little each year, and a person who is just inside one can find themselves just outside it, or the reverse, without their own income changing at all. Now here is who the protection leaves out, because these 5 groups do not receive a letter explaining that they are outside it. 1. Anyone new to Medicare Part B. If you did not have a premium deducted last year, there is no prior figure to protect, so you pay the full standard amount, whatever it turns out to be. 2. Anyone paying the income-related surcharge. That surcharge is calculated separately from the standard premium, so hold harmless simply does not reach it. And remember, that surcharge runs on a 2-year delay, so next year's is based on the tax return you filed for the year before last. 3. Anyone who does not have Part B taken out of a Social Security payment. If you are billed directly, quarterly, because you have not claimed your benefit yet, you absorb the whole increase. 4. Certain retired public servants who never paid into Social Security and therefore have no payment for the premium to come out of. They are billed directly and they carry every increase in full, and there has been legislation proposed to change that, which has not passed. 5. People enrolled in a state program that pays the premium on their behalf. Different arrangement, different rules. And then there is a limitation that applies to absolutely everybody, including the people who are protected, and it is the one that catches the most households. Hold harmless covers the standard Part B premium and nothing else. It does not cap the hospital deductible. It does not cap what you pay for prescription coverage. It does not cap a supplement premium. It does not cap the co-pays inside an Advantage plan. So the check is protected in a narrow way, and the costs it has to cover are not protected at all. And that is why so many people can look at an announced raise, know it is real, and still find that January is harder than December was. Now, if you think you might be in one of those 5 groups, here is what to do about it rather than simply worrying. Find out for certain first, and there is a simple way. Look at what actually arrived in your account last January against what arrived the December before. If the deposit went up, you were not being held harmless, because hold harmless only ever activates when the premium increase would have pushed you down. Most people in most years never touch it at all. Then, if you are billed directly rather than having it deducted, understand that you are carrying the full increase every year and always will be, and budget for it in November when the figure is published, rather than being surprised in January. If you pay the income-related surcharge, the appeal route is real, and I will come back to the form for it shortly. And if you are newly enrolled, you are outside the protection for 1 year only. Next year, you will have a prior figure on your record, and the ordinary rules apply from then on. That is genuinely worth knowing, because people hear they are unprotected and assume it is permanent. It is not. It is a first-year gap. Let me tell you about Bernice. Bernice is 67, and she enrolled in Medicare last year, which is the entire story right there, though she does not know it yet. She has friends. Her friends had been on Medicare for a decade, and when the subject comes up at the table, one of them says the check never goes down. They cannot let it go down. There is a rule. And that friend is right about herself. Bernice has no prior year premium on her record. She is outside the rule she has been reassured about by somebody who loves her and is describing their own situation accurately. She will find this out in January, standing in her kitchen with her phone in her hand, looking at a deposit that does not match what she was told twice by people she trusts. Nobody misled her. The most dangerous information in this whole subject is not the false kind. It is a true statement about somebody else's situation, repeated warmly, at a kitchen table, to a person it does not apply to. That is precisely what the guide exists for. Not to make anybody an expert in Medicare financing, to let a person work out in 10 minutes which of these rules is actually theirs, rather than inheriting somebody else's answer and finding out in January it was never their answer at all. Same place, kevinexplains.shop, link in the description and in the pinned comment at the top, and the code on your screen if you are watching this on the television. 7-day guarantee, no argument. A woman standing in a kitchen in January, holding a phone, looking at a number 2 people she trusts, told her could not happen. Now the third thing, the one September can quietly trigger without you noticing, and here is the figure I promised you at the start. When your raise arrives, it can make more of your Social Security taxable. Not because Congress passed a new tax, because of a line that has not moved since 1984. Here is how the tax on benefits works. The government calculates something called your provisional income. It is your other income plus any tax-free interest plus half of your Social Security. Then it compares that figure to a threshold. For a single person, the threshold is $25,000. For a married couple filing together, $32,000. Cross it, and up to half your benefit becomes taxable. There is a second threshold at $34,000 and $44,000, and above that, up to 85% of your benefit can be taxed. Now here is the figure. $25,000 and $32,000 were set in 1984. $34,000 and $44,000 were added in 1993. Not one of those 4 numbers has been adjusted since. Not for inflation, not once. In 42 years. Think about what has happened to every other number in this system in that time. Your benefit has been adjusted every single year. The taxable maximum has been adjusted every year. The earnings limits have been adjusted every year. The Part B premium changes every year. Everything moves except the line that decides whether you are taxed, which produces a result nobody ever voted for. When that rule was written, it was aimed at a small number of people at the top. Because the line stayed still while every benefit climbed past it, the share of households paying tax on their Social Security has grown every year, automatically, with no vote taken and no debate held. And it means something specific about September, because September is the month the raise is finished. For some households, this raise is the one that carries them across the line for the first time. They will get an increase, and part of what they gain will come back out as tax, and the letter announcing the raise will not mention any of that. Let me put a real household on that because the arithmetic is easier to see than to describe. Take a single person with a benefit of $22,000 a year and a small pension of $13,000. Half the benefit is $11,000. Add the pension and the provisional income comes to $24,000. Under the line by $1,000, so none of the benefit is taxable. Now apply a raise of 3.5%. The benefit goes up by roughly $770. Half of that is $385, which pushes the provisional income to about $24,385. Still under, this year. Do it again next year, and the year after. Somewhere in there the line gets crossed, and it gets crossed by a person whose real circumstances have not improved by a single day of comfort. Their pension did not grow. Their savings did not grow. The only thing that moved was an adjustment designed to keep them level with rising prices. That is the mechanism, and once you can see it working, you can see why the share of households paying this tax has climbed every year for 4 decades without a single vote. So here is what to actually do about it, because unlike the index, this one you can act on. Work out roughly where you sit. Take your other income for the year, add any tax-exempt interest. Add half of your annual Social Security. Compare it to $25,000 if you are single, or $32,000 if you are married filing together. If you are within a couple of $1,000s on either side, this raise is a live question for you, and it is worth an hour with whoever does your taxes before January. And know that you can have tax withheld directly from your payments rather than facing it in one piece in April. The form is W4V, the Voluntary Withholding Request, and it lets you choose from a short list of percentages. Nobody offers you this. It is entirely your choice, and it can be started or stopped or changed whenever you like, and for a great many people, it turns an unpleasant April into something that never needs thinking about. All right, what else can you actually do between now and the end of the year? There are 4 things, and every one of them has a date on it. The first is the notice that arrives in December. Every year, the agency sends a letter setting out your new payment amount for the coming year. Most people glance at the big number and put it down. Do not do that this year. Check 3 things: what the raise came to in dollars, what is being deducted for Part B, and what the net figure is, which is what will actually appear in your account. If any of those 3 surprises you, that is a phone call to make in December rather than a discovery to make in February. The second is the 7th of December, and this one is a hard deadline. That is when the window to change your prescription drug coverage closes for the whole year. Those plans rewrite their terms annually. The drug list changes, the tiers change, and the specific medication you take can move from one tier to another with the plan name staying identical. That is a genuine opportunity rather than a warning, because the money people save by moving to a better plan is frequently larger than the entire raise we have been discussing. So if you take regular medication, spend an evening on it before the 7th. The third applies if your income has dropped. If you are paying that income-related surcharge and it is based on a year when you were still working or when you sold something, and your circumstances have since changed, there is a form to have it recalculated. It is SSA 44, and it covers events like retiring, losing a job, a spouse dying, or a divorce. People pay that surcharge for a full year without knowing this form exists. The fourth applies if you are still working and drawing your benefit before your full retirement age. The earnings limits are adjusted every year, and they are announced at the same time as the raise. If you are anywhere near that limit, you want the new figure when it comes out in October, not when it catches you in the spring. Let me tell you about Talmadge. Talmadge is 80 and lives on his benefit plus a small pension from a plant that closed in 2004. For 3 years, he has been within a few $100s of the threshold, drifting up toward it, because the raise climbs every year and the line does not. The year he crossed it, nothing announced itself. He received a larger raise than usual, and he was pleased about it. The consequence turned up the following April, in a bill he had never had before, and he assumed he had made a mistake on the form. He had not made a mistake. He had received a raise, exactly as designed, and part of it had been reclaimed by a rule written when he was 38 years old and never revisited. He still cannot really explain it to his daughter, and I do not blame him, because the whole thing depends on a number nobody ever mentioned to him in his life. Now let me give you my honest opinion, which is only that, and you are welcome to disagree with me in the comments. I do not think the raise is a swindle. It is a real adjustment, it is applied automatically to every record every year, and a system that adjusts 75 million payments annually without anybody having to apply is a genuine achievement. Most countries do not manage it. And I want to be fair about the index question because it is easy to be cheap about it. The wage earner index is a serious measurement, it is not manipulated, and the argument that the elderly index is not robust enough to carry this weight is an honest argument made by serious people, not a cover story. My objection is narrower than any of that, and it is the same objection I keep arriving at on this channel. Every part of this machine that moves in the government's favor moves automatically, and every part that moves in yours requires you to know something. The raise is automatic, the premium increase is automatic, the tax threshold staying frozen is automatic, and it works against you every single year without anybody deciding anything. But the withholding form is not automatic. The surcharge appeal is not automatic. Checking the December notice is not automatic. Changing your drug plan before the 7th of December is not automatic. Look at the pattern. Everything a computer can apply to every record at once gets applied. Everything requiring a person to know a thing exists does not happen unless that person already knew, and nobody is assigned to tell them. That is the whole gap, and it is the reason a channel like this one has anything to do at all. And one more thing on that, because September is exactly the month it happens. Every autumn, as this announcement approaches, a particular kind of message starts circulating. A text, an email, sometimes a call. It says the raise requires you to confirm something. It says your new payment amount needs verifying. It offers to calculate your increase if you supply a few details. None of that exists. There is no confirmation step. There is no form to complete to receive your raise. There is nothing to verify, nothing to register for, and no fee anywhere in it. The adjustment is applied automatically to every record in the system, and the first legitimate communication you receive about it is a letter in December telling you what it came to. So, if anything reaches you between now and Christmas asking you to confirm, verify, or unlock your increase, that is somebody attempting to take it from you. Put the phone down and, if you have a real question, look the number up yourself rather than using one you were given. All right, here is your list. 5 things, and every one has a date attached. 1. On the 14th of October, write down the announced percentage. Then wait for the Part B figure in November, because the second number is what determines your actual deposit. 2. When the December notice arrives, check 3 lines rather than 1. The raise in dollars, the Part B deduction, and the net. Query anything that surprises you in December, not in February. 3. Before the 7th of December, review your prescription drug coverage against the medications you actually take. For many people, the saving there is larger than the raise itself. 4. Work out your provisional income, other income plus tax-free interest plus half your Social Security. If you are near 25,000 single or 32,000 married, get advice before January and look at Form W-4V for withholding. 5. If your income has fallen because you retired or a spouse died or you were divorced and you are paying the income-related surcharge, file Form SSA-44 rather than carrying it for a year. And if your own situation is tangled, if you cannot work out whether you are inside or outside any of these rules, write to me. The address is on your screen and in the description below, and I read every one that comes in. One last thing before you go. Cordell has written a percentage in a notebook every October for 11 years, and not once has anybody explained why the figure he writes down is never the figure that arrives. Bernice is going to discover in January that a rule 2 people she loves told her about was true for them and never applied to her. And Talmadge crossed a line that has not moved since 1984, got a raise for doing it, and paid for the privilege the following April. Not one of the 3 of them did anything a sensible person would not have done. Not one was cheated by any person. Every one of them was on the wrong side of a design that nobody was ever assigned to explain. So go and look this September, while the number is still being finished, and there is time to prepare for whatever it turns out to be. Know how it is built, know what comes out of it before it reaches you, and know which of these rules is actually yours, rather than somebody else's answer passed to you across a table. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.